So there are really four investments that I think the majority of individual investors out there are going to utilize on their accounts. Those are stocks, bonds, mutual funds, and exchange-traded funds. And so let's start with stocks. I think most people are comfortable with stocks, but they simply represent an ownership interest in a company. And in receipt of that ownership interest, you share in the future profits of that company. So if the company has dividend payments, as a shareholder, you're going to receive that dividend payment. If the company grows in value, that's going to reflect in its stock price, and the stock price is going to go up, and you're going to share in that capital appreciation of the stock. The second type of investment is bonds. And quite simply, a bond is you as an individual investor loaning money to a company, and in return, that company is going to pay you interest for your loan. Now, at the end of the loan term, of course, you're going to get your money back, hopefully, and you'll also, again, receive any interest throughout the course of the loan. A mutual fund is simply you as a mutual fund shareholder, you provide your funds to a mutual fund. The mutual fund has a mutual fund manager who goes into the market and they buy the securities for whatever type of fund it is. So let's say it's an aggressive stock fund. The mutual fund manager is going to go and buy the stocks of companies that they believe are growing aggressively. And then lastly, an exchange-traded fund represents a direct ownership in a basket of securities. So it's similar to a mutual fund, except you have more of a direct ownership interest in the underlying securities themselves. So let's take a S&P 500 index exchange-traded fund. You're going to have an ETF that owns the stocks of the 500 or 500 of the largest companies in the United States. And similar to a mutual fund, you're going to share in the gains and losses of those companies on the market. And really, when you look at all four of those investments, I would say that for individual investors, trying to pick out individual stocks and bonds can be extremely difficult. You have risk in that. If the company doesn't do well, if the company goes bankrupt, you can lose your entire investment. For most investors, mutual funds and exchange-traded funds are going to make more sense because you have more diversification. You're going to own the shares of many companies, or you're going to own many bonds within the funds. And so then if you look at mutual funds and exchange-traded funds, it's really just looking into, okay, how much does it cost to invest in those two investment vehicles? What does the tax situation look like within those two investment vehicles? What is the performance? If you look at mutual funds, a lot of mutual funds, they use active managers. You have to look at what has the performance been over time in those. Exchange-traded funds are more passively managed products, so they simply track an index. So those are really the four investment vehicles that you want to look at as an individual investor.